My name is Phil Fogel, and I'm one of the founders of Cork Protocol. I want to spend the next 14 minutes on a specific question. How does risk get priced and risk capital raised, allocated, and deployed in a world where the participants are machines? The topic is structural. It's about what changes and what gets unlocked when the buyer and seller of risk is no longer a human at a desk, but agents with wallets. No one is at this summit because the agent economy is coming. You are here because it's already arrived. 250,000 daily active transactions on chains right now. That's a 400% growth year over year. In financial services, non-human identities outnumber humans 96-1. Service accounts, trading bots, risk engines, increasingly agents. More and more, all trading that is done by machines. 165 million transactions on the X402 protocol, the payment standard that Coinbase and Cloudflare shipped this year for machine-to-machine payments. The user has changed. The risk infrastructure has not caught up yet. The agent infrastructure stack has 4 layers that are already built and 1 layer that is missing. Identity is done. ERC 8004 went live on mainnet in January. Wallets is done. Coinbase Agentic Wallet shipped in February, along with Turnkey and half a dozen others. Payments, done. X402. Execution, done. DEXs, lending markets, Vault framework. Risk, nothing. Agents can create risk. Agents can amplify risk. They cannot manage or transfer risk. And that's the gap. And this isn't theoretical. Let me show you exactly what agents amplifying risk because they can't manage it looks like in production today. When LayerZero's rsETH exploit hit earlier this year, curators like KPK ran exit agents inside their Morpho vaults. The moment the risk signal crossed the threshold, those agents did exactly what they were programmed to do: liquidate, pull the capital out and exit. The agents worked. They executed in milliseconds. They protected their depositors from the worst case path. In fact, in the last presentation, we saw another example of that happening. But here's the thing. That is the best-in-class agentic risk management that exists today. But notice what wasn't available to those agents. They couldn't hedge the position. They couldn't buy partial coverage. They couldn't negotiate a counter trade with another agent who had a different view. They couldn't structure a swap that paid them out below a NAV threshold while keeping their upside. Their only tool was out. And when every agent's only tool is out, the second order effect is what you'd expect. Liquidity dries up. Exits cascade. Risk that could have been priced and traded gets resolved by everyone running for the door at the same time. That's not risk management. That's a coordinated stampede that amplifies volatility and increases systemic risk. We need to give these agents more tools. Here's where almost everyone gets things wrong about risk in this space. Everyone hears risk and they think one of 2 things: hedging or insurance. Risk on, risk off. Get me out when something goes bad. That's the wrong frame. The right frame, the one that actually matches what agentic finance does today. Seems like this is the wrong slide. There we go. That's the right one. So the right frame is the one that actually matches what agentic finance is going to demand, which is risk customization. Take a single Morpho vault token, 1 asset, 3 different Michael Burrys walk in, same vault, 3 completely different requests. User A, I want protection if NAV drops more than 3%. If it does, allow me to swap my vault token for stablecoins at 97 cents on the dollar. User B, I don't care about downside protection. I care about liquidity. I want on-demand liquidity at NAV anytime. The user C comes in and says, I don't want to swap. I want downside insurance that will pay me up to 10 cents per dollar if NAV drops. 3 different risk shapes, 3 same underlying asset, different trigger, different settlement mechanic, different premium, 3 completely different products. Today, in DeFi, in TradFi, anywhere, these products do not easily exist for the user. You take what's on the menu, or you walk away. This is what risk customization starts to look like. And so why couldn't we do this before? The answer is mechanical. Human underwriters can't price n versions of the same risk in real time. The economics don't work out. Geico solved this in the 1990s for auto insurance by replacing the human underwriter with an algorithm. But Geico still gives you a fixed menu. You pick your car, you pick your tier, you pick your deductible from their choices. Agents let you replace the menu itself. With agents, you can fully customize price and trade any risk, creating more sophisticated instruments and strategies. Agents aren't a feature of risk markets. They are the only reason risk markets at this level of granularity can exist. Before I show you what we've built to enable all of this, one more frame. None of this is possible on the rails we have today. Agents can't transact in TradFi infrastructure. It's built around humans, around paper, around ISDAs and KYC checkboxes and unstructured email. An agent walks up to that infrastructure and bounces right off. What agents need is the opposite: structured data, deterministic addresses, atomic settlement, composable state. There's exactly one substrate where all four of these exist together. And here's the bigger forecast. Most trading volume in crypto is already AI-driven. The same trajectory is coming for traditional finance. When AI runs capital allocation at scale in TradFi, it has to run somewhere AI can actually operate. The only substrate that's fit for purpose is tokenized. Institutional capital is coming on-chain, but they need more than exit-only risk management. So here's what we've built. Cork is one smart contract structure, one template, configured by Oracle, by collateral, by trigger, but always the same shape underneath. Here's how it works. Take any on-chain asset that has risk: a yield-bearing stablecoin, a vault token, a tokenized treasury, or any RWA. A liquidity provider deposits collateral against that risk. The contract issues two tokens, a swap token and a principal token. The liquidity provider or underwriter holds the CPT, the Cork principal token. That's the underwriting position. The LP then sells the swap token for a premium. If the trigger never fires, the LP's principal matures back to them, plus the premium they've already received. The buyer holds the CST, the Cork swap token. That's the policy. It grants the right to swap the reference asset or trigger a payout for the collateral at a predefined rate. Two parties, two tokens, one contract, fully collateralized from the start. No margin calls, no counterparty defaults. The same primitive handles a stablecoin depeg, a vault redemption delay, a NAV trigger, or a real-world insurance event. Only the configuration and the Oracle changes. All three of the user examples from before can be created seamlessly on Cork. Now, Cork wasn't retrofitted for agents. It was designed for them from the start, with a singleton architecture, deterministic pool addresses, ERC 7683 rollover intents, and off-chain quoting with on-chain settlement. You read the state, simulate the price, mint the CST. That's the whole loop. No middleware, no human-facing UI to scrape. Not retrofitted for agents, designed for them. Now, once you have the primitive, three things stack on top. At the base, agentic market creation. Agents spin up pools on demand. Each asset gets 6, 12, 200 variants tuned to different buyer preferences. The marginal cost of creating a new market drops to near zero. That solves the cold start problem that every risk market has faced. In the middle, you have agentic primary underwriting. Once a market exists, agents on the supply side price it. They model exercise probability, premium curves, break-even NAVs, adverse selection, etc. They post limit orders, capital gets priced into the freshly new created markets. And then at the top, you have agentic trading and underwriting between vaults. Tranched CPT portfolios, reinsurance-style secondary risk transfers, structured products built from composable primitives, pick risk by sector, by duration, by trigger type, tranche it. The way fixed income desks have built credit books and securitizations, except now the desk is software. And on the demand side, the agentic buyer, the agent on the other side of every one of these markets, the one that today has the only tool is out. So why does this matter for anyone who's not just playing in DeFi? The same primitive serves three markets at three different time horizons. So DeFi today is about 79, 80 billion in TVL. And roughly 120 million of that has any form of real risk coverage on top of it. And most of that is coming from Nexus Mutual. And almost all of that is just covering smart contract risk. The financial risks that actually matter in finance, NAV drops, depegs, LST slashing, bad debt, has effectively zero coverage. The category essentially doesn't exist yet. Outside of that, we're dealing with real-world assets, which right now are 26 to 29 billion in tokenized RWAs as of last month. And that's up 4x from a year ago and only growing. As more credit moves on chain, you need two things in parallel: liquidity infrastructure for redemptions and credit default swap-like pricing for on-chain for the credit risk itself. Neither exists at scale yet. And then the big prize, traditional insurance, with $7.2 trillion in global premium. This industry runs on systems built in 1988. When these traditional risk contracts come on chain, we will see massive efficiency gains, faster settlement, and a new capital formation stack that will lead to more competition and ultimately lower premiums. This is all built on the same primitive. 3 different markets, only the configuration changes. So now here's the universal truth that everyone in this room already agrees on. Blockchain is the rail for agentic finance. We all believe that. But every layer on top of that rail has needed its own infrastructure. Identity is being built, wallets is shipped, payments shipped, execution is the most mature layer of all. Risk has barely started. That's what Cork is, the rail for risk. The loop is being built right now. In the next 24 months, capital formation in agentic finance either gets built on programmable risk primitives that are transparent, composable, fully collateralized, or it gets built on the same opaque bilateral off-chain plumbing that gave us 2008. Now picture the Big Short scene in 2028. No Goldman desk, no ISDA, no suits in a conference room. The user types, hold this position for 6 months. I need 100% exit liquidity on 250K of notional. The agent finds 3 underwriters, quotes the price, gives you the best price of 280 bips. The CST mints to the wallet. Atomic settle on accept. Tokens land in the wallet. That's the future this room is here to build. Thank you.